Good evening, subscribers and invited guests, and welcome to the bi-weekly IMA webinar, April 24th, 2012. My name is Jeff Kilian. I am the founder of the Inside Technician, trader, technical analyst, and educator. And tonight, it's my pleasure, my absolute pleasure, to present a subject matter that we have never covered before, never ever covered before in the IMA webinar, entitled Using Fibonacci to Determine High Probability Price Targets. So before we get into the presentation, we just have to run through a quick disclaimer so that we can satisfy the compliance department, and we'll be off and running. The Inside Technician, nor any of its principals, employees, or partnerships makes any recommendations to trade any securities in any marketplace at any time whatsoever. The services offered are strictly for educational purposes, and the client assumes all his or her own risk when making any of its own trading decisions when trading any securities within any marketplace. Our educational services are all designed to educate the client in employing the correct application of technical analysis to then be able to make better informed, self-directed trading decisions. That being said, let's get back to the title. Again, the title for tonight's presentation is Using Fibonacci to Determine High Probability Price Targets. What we're going to go through in tonight's presentation is a brief overview of Fibonacci, how it applies to real-life trading. I'm talking about what we can use every day in our technical analysis to be able to determine what are the real probabilities for future directional price movement. In this case, determining high probability price targets, also the correct application of this technique created by Fibonacci to be able to determine superior support and resistance levels, and when those levels as well can be used as high probability price targets. Tonight we have a very special guest with us, a gentleman by the name of Adrian Bickham, Canada, who is the most recent student that has come across who has been willing to go every day, toe-to-toe in studying with me for a full 20-day, full, exclusive mentorship program. And I have not instructed him in any way whatsoever as exactly what he should say. I only mentioned that he could talk about what his experience was here and how it's affected his trading, his real-life trading. So about 7:30 or so, we're going to hear from him. And I think this is something that everyone can benefit from, because this is the most recent client that has actually taken the step to commit himself to really become a real-life profitable trader by studying here, specifically with me. Excuse me. We're going to start with the Dow, and we're going to run through an analysis of the Dow, and then we're going to get into continuous contracts on the S&P E-minis, and right into the 15-minute, 5-minute, and 1-minute charts. Again, using the correct application of Fibonacci retracement levels to determine high probability price targets. Okay, so let's get out of this and let's get right into the Dow screen. And here we go. Okay. You're looking at a end-of-day candlestick chart of the Dow Jones Industrial Average with the volume in the subgraph below. Now, everyone knows that I am a large proponent of volume and how it actually acts as the catalyst for the largest price moves that the market, individual securities, or the E-minis will see. Our main theme here, our core of our methodology, the very essence of the methodology, is to find, track, and trade smart money. These are the institution people the institutions that come in here with this huge volume spike on the Dow side to initiate a brand new trend to the upside and sustain it with this kind of volume accumulation for a long period of time. Now, when we look at this in isolation, it has significance, especially at market turning points, pivot points like here and here and here. And again, the most recent volume significant spike on 316 here. These types of volume spikes at pivot point highs and lows will act as a forewarning to what prices will do in the near-term trading future. Let's go back and let's take a look at how Fibonacci applied to the Dow and how it depicted levels that we could have traded off of in anticipation of getting to price profit targets. Back here, those of you that are with us, and we have quite a few new subscribers with us tonight from the most recent PFG presentation out in Chicago a few days ago. So for those of you that are new, back here at this point in time when I was demonstrating an IMA webinar just like tonight, okay, we inserted Fibonacci retracement levels because at this time, this is all we had. And in order to initiate Fibonacci, we need a pivot point high and a pivot point low, or a base formation high and base formation low. In this case, we had 2 pivot points. The termination of that pivot point is established by an up day, and we connect the highest point within it being here as the initialization area. The secondary is here. I have taken liberty of putting these arrows here so you can clearly see the areas that need to be connected. This is how we first initialize Fibonacci based on the correct application of technical analysis. Time goes by, prices trade up from this level that we have established. They find 38.2, turn right back around, trade down, trade back up. The highs find 50% exactly. Prices trade back down, right back down to a 0% retracement here one more time, creating a brand new double bottom as soon as prices have traded up from there, which was the case. Now, since that point, prices traded up and back down, and here at this point, laid out a shakeout, this shakeout being 2 prices here from these 2 different days that are lower than the last 2 previous higher pivot point lows. Now, at this area, the question is what to do. Most would leave the Fibonacci application as it was, but this is not the case. We have to reconnect to a new data point which has just recently arrived. And this is the way we do it. We simply take this area here at this pivot point connection, and we move it to the new lower level, the lowest area within this newly established pivot point low, which was completed by the up day. Can everybody see that clearly? I'll blow this up for you so everyone can see this just a little more clearly. If you have questions, you can enter them into the question area, and I will get to them as soon as I can. We have a lot of information to cover tonight. We have an incredible presentation put together just for you on the subject matter, so we will answer them as best we can. Okay, everyone can see this clearly. Now, time goes by, the future unfolds, and prices, almost a double top here, trade through 50% and trade up to 61.8. One thing I'd like to include here tonight, before we go any further, is a new level which is not defaulted with most programs, but is a level that has specific application to high probability price targets and support and resistance levels within any market, whether it's analysis of end of day in this case, or on the 15-minute charts for real time, and that level is 74.6. Add, apply, and here it appears. A level which was not previously laid out, now broadcast out into the future like all these levels were. Prices move up, and they hit 74.6 exactly here on the close of 10/27/2011. Trade a few points above it and right back down. This was the superior resistance level at this area, which prices hit and turned right back around and traded back down from. Prices hit almost exactly 50% retracement and trade back up. Is anybody seeing how valuable this technique is just using it in isolation? Lay it out on the Dow. This is amazing, isn't it? I almost have to check myself sometimes because it's very easy to take this technique for granted. Once learned, put into practice, it is extremely powerful, as you can see. To be able to do what? Predict the price profit target at this area and get out, cover, go flat, or better, maybe go short if that was the case on the indicators that we follow every day. You bet. A great way to know in advance where we should be getting out ahead of time. Prices continue to hit this area at 74.6, trade right back down, come close to, but not exactly to 23.6 on a pivot point low, and then things change. They trade back up to where again? 74.6, and history moves up to a full 100% retracement. We have a small sell-off here by the insiders, which acted as a catalyst for the short-term correction here. By the way, I called that on an IMA webinar. For those of you that were with us, they know it. Faithful subscribers, thank you. And now we have the infamous 13,000 level here, and I call this as a potential blow-off on prices on inflated highs, okay, because of reaching that level with no continued strength, real continued strength within the indicators that we cover. Okay, here the blow-off level is established, an official double top here, and here comes the insider sell-off, which I called, which at that time Adrian was studying with me, and he had the honesty to admit at that time he wasn't buying it, that it was a sell-off. But I said it was because of the indicators that we follow every day. So now for those of you that are with us, it's very clear to see that we have a trading channel that's been established between the 13,000 level, the new pivot point highs that have been established, creating an official double top here. We have a long-term trend line that's been established from here to here, broadcast out into the future, waiting to see if this level is going to get violated because of a potential sell-off here. Yes. And what happens? Prices turn back around, and what are we looking for? We're looking for prices to hit the 100% retracement level that Fibonacci laid out previously, right? To use it as a new support level of prices trade back down to hit it. So if you're going to be short after the double top and the trend line's violated, you can be darn sure that you're looking for prices to hit first 13,000 level and then your secondary level right here at around where this pivot point low was established, right here at right around 12,730. What happens? A triple top. The trend line's violated right here on April 4th. Prices tank back down, and they hit right here exactly on the close of 410. The 100% Fibonacci retracement level that was laid out, that was once resistance, that has now become superior support. Is that amazing? I believe it is. Prices continue the next day. They open right there and they close up shortly. And this is exactly what happened. I shorted the S&P in this area right here and made a lot of money. We're going to get into that chart shortly. But even if you shorted a mirror fund of the Dow, an ETF, you would have known clearly that this was the point, the ultimate, most precise entry point to be short here, and then take your profits here and get out and wait to go back long or for the next high probability trade. Right now, the Dow is in a trading channel that's been established here. From these two data points, it was this range here, and now it's closed up to be something a little bit shorter, as in around this area and right here. The most recent channel is right here, exactly. Okay, I hope everybody understands what we've covered so far. I know we've covered that. A lot of information. We have a comment in here. Amazing. Would that be 76.4? That is what my Ninja Trader Plus says. No, it's not. It's wrong. It's 74.6. Right. This is the correct application of technical analysis. I have a complete white paper that I wrote on the Fibonacci levels. As a matter of fact, my mathematical computations are published in various areas. Okay, including Wikipedia, by consent. There's a lot of things going on, people. We have a book that I'm writing right now, The Essence of High Probability Trading. We are coming out with a brand new article in Stocks, Futures, and Options magazine in May with an accompanying video. TradersWorldMagazine.com. Larry Jacobs, winner of the 2001 Stock Trading Championship worldwide. I have a new article, part 2, of a most recently published first section regarding, a lot about sector rotation and securities, how to really read these setups as they're coming along. It's all about high probability trading. We are regular contributors to PFG Best Out in Chicago, educational webinars, a lot of things going on this year. So that depicts that area. Here's your long-term trend line that's been established here. Again, here's your violation, signaling that the trend has officially changed because of a down close. Here, we have a substantial preliminary first, negative divergence, secondary here, and third to this level right here, as prices have formed a triple high, indicating that we do have significantly more issues, securities, that are declining versus advancing. The ratio has changed. The changing of the guard has already taken place. We're up here on inflated highs waiting for the substantial short-term correction. Here on the MACD, our trend following indicator. Okay, we had a long-term negative divergence here. The cross was way back here and more downward momentum before prices sold off. Here on the money flow index, same story. Substantial negative divergence as compared to the prices here, and a severe sell-off way in advance before the prices actually tanked. A good way to be able to get out of equities if you were long, a longer-term player, go flat, cover your positions, and then go short, or better yet, study here. I learned how to short the S&P E-mini and make a lot of money in a short period of time. Substantial point move from here to here. I was waiting for this move for a long time. I also caught this one as well. A lot of money made in between here. Market net neutral, doesn't matter. The 15-minute chart setups rule as compared to the end-of-day data points to be able to take the trades. Longer term hold times, a little bit. 3, 5, 7-point moves is what we cover here. Yeah, as compared to 3-point moves here, absolutely. You're welcome, Phil. Remember, any questions, fire them in there. The question that you ask may benefit someone else, that someone who maybe is a little reluctant to participate but could learn. The key behind this webinar is, this webinar is free. Nobody gives away this much actionable intelligence besides me, and I do it. You know why I do it? Because we're real. But there's a lot of educators out there who proclaim to be real-life traders, and I can tell you, They're not. They say that they are, but they're not. And I have no problem with saying that. You know why? Because here you see everything that I do in a fully transparent environment. And those of you that have studied with me, a full mentorship program, 10, 20 days, full attention, know that there's been a lot of times when we've studied together, when we've been at the right place at the right time, to see the market corrections through, as I call them, to see real-time trades, as I've called them, and as I've taken them. Right. Exactly. Check and money flow. Preliminary divergence, secondary. What else did you have? Prices, triple top here. A third negative divergence before prices tanked. What more does a good technician need? Once you learn how to interpret these indicators, you go to bed with these indicators. You sleep with these indicators. You extract as much intelligence as is humanly possible out of these indicators, right? The way that I will teach you to interpret them. Your trading takes on an entirely different level. Everyone says the same thing. This is not me talking. So when we look at these charts and we look at the opportunities that are here, stochastics here, another one. Stochastics momentum. By the way, the Inside Technician, we are official Metastock trainers. We are an official Metastock partner in the trainer category. It doesn't come too easy in the field of technical analysis. So we are supported. We are stamped, signed, sealed, and delivered professional trainer in the field of technical analysis. Again, that doesn't come too easy. Here's your secondary divergence right here before prices tanked. Excellent indicator. You're leading scout to determine future directional price movement. So those of you that are with me, and I say those of you that are really, really paying attention to what I'm saying to you, and I want you to take this with you tonight, is that your greatest positional advantage as a professional trader, once you learn how to do this, is patience. You wait for these trades to come to you. You do not chase them. Learning how to identify setups on the market side, the 15-minute charts, so that you only trade when the true high probability trades come along. And why? Because you limit your risk to a minuscule amount of money in the trade itself, because you keep a nice close stop as compared to the chart pattern. The market is on your side, right? The 15-minute charts are on your side. Everything's lined up. Then you trade with conviction because you are at the right place at the right time. This is all part of the learning process. Everything in life is a process. And so is your developmental education here. Okay? So we're going to get out of this and let's get right into some continuous contracts real quick here in the near month being June, and then we'll go to real time. The E-mini futures continuous contracts we use to analyze and trade with, to draw from, because all the contracts are rolled from one to the next, and we have continuous data. Most traders are trading off the June contract, and they do not have the ability to analyze the correct amount of data to make real trading decisions. I mean, I'm talking about the type of decisions that you can trade off of and actually make money. Again, here, insert Fibonacci. We're right back to where we started before on retracement levels. In this case, we're going from here to here. And in this case, again, we're going right back to plus 74.6. And I'm glad we did this tonight. I'm glad Phil brought this up because it's important to have the correct numbers. instead of a canned program. Add, apply, close, and there it is, 74.6. So at this point, right, when we had this established, okay, prices trade up right at 50%. Remember the Dow, what happened? Traded back down, okay? Found the new pivot point low here. At this point, I'm taking this and I'm connecting it to here, okay, because of the lower level. Prices traded up right through 61.8 where they stalled out for 2 days after this high had reached it, traded right up to 74.6, and that's where they stalled out again. Just imagine, people, if you had been tracking this technique and you saw it on the Dow and the continuous contracts, do you think that that would have given you enough conviction to say this rally, in accordance with the other indicators that I just demonstrated to you, when you use these techniques in combination, it's time to get out, go short or flat, and wait for the next setup? Of course it would. Notice you didn't include the wicks. Why? Okay, good question. The correct application, and I'm not trying to be pompous or anything, because a lot of people do this wrong. I'm simply saying that the mother of all time frames is end of day to begin your analysis, right? So every trader knows where they stand every single day in the marketplace, okay? But the mother of all reference points is the closing price. At the end of the day, literally speaking, at the end of the 15-minute chart, 5-minute, or 1-minute chart, whatever that closing price is what some of all market participants have decided, that that's what that instrument is worth. The highs and the lows are probes for the possibilities of breaking through from below to above or from above to below, support and resistance levels as a probe, again, to determine continued price movement in the direction of the probe. Do you understand that, PS? Okay. Okay, good. Any more questions, you can fire them off. 3 words run together, theinsidetechnician@gmail.com. So prices trade, and they keep moving, keep moving. Here we are, in a case we're above 100%. One more time, right? And now we're using this level again like we did on the Dow to gauge where we might find support. It was just a few points further away than the Dow, but it was real close, wasn't it? So there you go. Short, again, go flat here. Trading channels established. And there you have it. It's really quite that simple. Now the question becomes at this point, so now that we have a new pivot point that's been established here, these twin highs, you know, whereas in the Dow we had triple top, what do we do? What do we do now? And the answer is, once this has happened and prices have corrected, one application falls off and another, a brand new application, has to be constructed. And so what do we do? Let's get rid of this and move this over so you can see this clearly. Here's the lower pivot points compared to this one, the shakeout, remember, before the rally up. Here's your connect point right here where the arrow is. Okay, it's actually to the left side of the arrow because this is the lower data point. And here is the secondary level right here. Now, does anybody think it's quite a coincidence that the previous Fibonacci level that was laid out, which was right about here, has now been moved down to here? This was identified on the way up, okay? This was identified on the way down. The only logical explanation I have is that one way or the other, these ratios, when laid out properly, when you learn this technique, provide a way for you to find your way back when things change. It is a fail-safe mechanism that the law of numbers has laid out for you to be able to find your way back. And in finding your way back to previous price levels that have been laid out, right? When Fibonacci coincides with those price points here, it allows you, again, to put your trading on an entirely different level. Now, mind you, you're looking at Fibonacci in isolation. The actual charts here, for example, the checking money flow, depicted a very similar but not the same story before the sell-off, didn't it? You bet it did. And so if we look at this trend line right here and we go back to here, we can clearly see the identification between this chart pattern, the higher one, and the lower indicator level, the longer-term divergence, right? The sloping trend line as compared to the uptrend, the disparity between these two signals clearly that we have imminent price movement to the downside. I also teach here how to correctly identify these types of areas here and then again here, so that when the trend line violation comes into play, okay, it's another confirmation that the trend has changed. Money flow as well, divergence here from this data point to here, inflated highs, the blow off, prices turn back around, that's where we are. We're waiting for the new data to be filtered through right here to construct the most recent end of session. Here, the trend line violation on the continuous contracts. Remember the Dow? Same thing. Here, the long-term advanced decline trend line breaks here at the time sell-off came into play. Here, stochastics, negative divergence here as compared to the prices, building the case from one market to the other, looking for the confirmation. These markets are highly correlated, people. If you're looking at the Dow, where you get the volume signals that you don't get on the S&P or the continuous contracts, it's because the Dow is a different nature. 30 stocks. The S&P 500 cash side equities is 500. But you can be sure that the equities are pushing the futures. Before the equities open, the futures usually determine what direction the equities are going to go for at least the opening of the current session on the open equities side. Okay, enough of the case here. Here's the demonstration of the long-term negative divergence on the MACD before prices fell off, indicating sure weakness within this chart pattern. The imminent sell-off. Here's the cross. Here's the downward momentum. Okay, so let's get right into the real-time charts. Before we do that, I want to introduce someone, and we will go ahead and open the 15-minute charts, let them load up, and get into one screen here. The correct application of technical analysis. The correct application of technical analysis really is critical to becoming a professional trader. Whether you're trading the S&P 500 E-mini futures or trading U.S. or global equities, it doesn't matter. It's all about measuring the true ratio of supply and demand, who's in control, when that changing of guard is happening, and how to capitalize on it. And by incorporating Fibonacci retracement levels into your trading methodology, you can potentially generate higher percentage returns and minimize your open risk, as you have just seen. The correct application of Fibonacci retracement levels when used in conjunction with superior indicators, like I just demonstrated, provides a totally transparent view of your trades. Now, this highly guarded technique, once learned and put into practice, provides clear and real actionable intelligence traders to help elevate your trading to the professional level. And it provides added risk management to your trading that will allow you to stay in the business. Here's the key. Superior risk management. Stay in the business year after year as a professional does. And obviously, learning this technique will help you avoid the pitfalls of substandard trading, which is what most everybody was doing before they walked through the door here and signed on with a commitment to a long-term exclusive mentorship program. When you combine Fibonacci ratios with the smart money trading methodology, you're going to be guided. Here's the key, into the direction of selecting only the true high probability trades. This is the way to do it. So now I'd like to introduce my most recent client, who I believe is going to be an outstanding, just an outstanding trader in very short order. He has experience in trading in options. He has experience in trading for many, many years and has taken courses at another school, another location, and signed on for a full 20-day exclusive mentorship program with me. His name is Adrian Bickham from Canada, and I'm going to unmute his microphone so we can run a test and make sure that everyone can hear him okay. Adrian, go ahead and say a few words and run a test, and I'd like people to raise their hands to make sure that you can hear this gentleman okay.
Hey, Jeff, how's it going, buddy?
I'm good, and yourself?
I'm very well, thank you. Can you hear me okay?
Can we get a raise of hands to make sure that everyone can hear Adrian okay?
Yeah, I just want to make sure nobody misses anything.
Dave, Eduardo, Jack Pincus, Janet. Okay, it appears they can. This is unrehearsed. Adrian, you're free to go ahead and cover what you'd like to cover for a few minutes regarding your experience here.
Well, first, Jeff, thanks very much for inviting me out tonight. It was a huge pleasure for you to ask me. I do believe we have one or two more sessions left, but I'm at the end of the actual training. We did the executive, I guess you would call it the executive level, so we went toe-to-toe for 20 days.
Right.
And I got to tell you, man, it was, you know, if you think you got a lot of information just from the webinar tonight, imagine 20 days, you know, of dissecting each of these indicators that, you know, was just absolutely amazing to watch them play out as the markets go out. I mean, you can train for a week and you get a ton of information, but, you know, over the 20 days, it was really great to actually watch the changing of the guards as it happened. You know, as Jeff mentioned earlier about, you know, April 4th when we had that break from the trend line and things started to go up a little bit, I was like, you know what, I'm not buying this. There's just too much weakness going on. I was like, no, I'm not buying this. So, and then sure enough, I think it was a week and a half later, we actually had that trend break and you know, we ended up making some money on that, on those couple of days, which was really great. But, you know, I'm at a loss of words because there's just so many things I'd like to say, and like Jeff said, this is unrehearsed, so I was trying to think of the best things to say here. But I mean, I've been trading for about 7 years. I've traded options. I made a lot of money in the crash of '08. Made a lot of money in the crash of '08, and thought I had it covered. I thought I was on my way to making a lot of money, and then I ended up, you know, running into a lot of problems that, you know, most traders go through, simply just because I was undereducated at that time. I had taken a couple of courses with another school. I did learn a lot, and I did make some money, but the stuff that Jeff and I covered, man, it was just like, you know, I went from driving a golf cart to driving a Hummer. You know, I mean, it was absolutely crazy. And you know, and from a subjective point of view, as far as how I feel about my trading now, I mean, I was at about maybe a 2.5, 3 before I met Jeff, and now I'm at about, you know, an 8, 8.5. You know, I still got some practicing to do. I still have to apply a lot of this stuff, but, you know, if you're in it for the long haul, if this is something you're really serious about doing, then, you know, you need somebody to show you how to get to the next level. Somebody who's been there, who's got the experience, who understands these indicators, you know, better than he knows his back of his hand. I mean, it was just an incredible experience, absolutely incredible. And but the best part was actually going through the changing of the guards. I mean, I think that was I think that was just absolutely amazing to watch how they unfold, and watching the indicators. I mean, the money flow and the Chaikin money flow just drop, you know, and the price is not going anywhere. I mean, where else are the prices going to go? There's no more money left. You know, the money left the building. Where else are they going to go? And that gives the, you know, that gives you the highest probabilities, you know, which is what we want as traders. We want consistent, high probability trades, and that's exactly what, you know, what Jeff helps you with. So, you know, just a great experience. I mean, anybody who's seriously considering, you know, doing this with Jeff, I highly recommend it. I mean, you know, it's going to pay for itself and then some. Yeah, that's all about I think I have to say at the moment, Jeff.
Okay. Well, thank you for the positive feedback. I definitely appreciate it. You know, there's so much to this, from stop placement to knowing exactly where to get in and exactly where to get out based on, you know, the end of day charts, going to the 15-minute charts, the 5-minute charts, the 1-minute charts, that, you know, there's a lot of information to cover. A lot of information to cover. But it's all done in a sequential order. This is the thing, people. A sequential order so that you go through the process and are able to go from one level to the next level, to the next level, and the next level. And along the way, you can be sure, excuse me, that I'll be asking you, do you understand exactly what I have said to you before we continue? And we do a lot of screen sharing too. You know, you have to present back to me, excuse me, the same way I present to you, so that I know that you understand exactly what I have trained you to be able to identify with. And my webinar program has the ability to allow you to present back to me. And I really like this part, because this is really where the rubber meets the road. So here we are on the 15-minute charts. And if we go right to our friend here, so they don't leave you out on the Fibonacci application on 15-minute charts. Okay, I want to show you what I was looking at. And what I was looking at is the same thing that I indicated before. A previous pivot point high and a newly formed pivot point low, as identified by these two boxes right here. So I'm looking for the highest point here and the lowest close here, or open here, or combination thereof. And I'm looking to insert Fibonacci right out of the Metastock Professional program. By the way, if you people are interested in this program, you can just go to my site, theinsidetechnician.com, and go, and you'll see the links right there. You're going to get the lowest prices in the business. I have a contract with Metastock that we offer the lowest prices whatsoever in the business, period. So here we are again in a situation where prices fell off. Here's where we established the actual Fibonacci application. Prices traded up. They found 38.2, traded up again, blew right through 50 and halted real quick at 61.8 for superior resistance right here. Traded sideways, traded up again. Okay? And let's not forget our old friend, 74.6. Add and apply. What happens? Prices trade up again. They find real close to 74.6, trade back down, and then trade up for the end of the session today, right back to 100% retracement level. Does anybody think that that might be the time to be out if you were long? Yes, absolutely. We have a question that's come through. How about shorter time frames? That was at 7:29. Yeah, exactly. So now we're into the demonstration on the 15-minute charts. This session, the new session is open. Prices are holding at this 100% retracement as we speak. Real-time trading marked to the market at 1387.50 on the E-minis. Now, one would be looking for prices to correct off of this and trade back down. probably in another hour or two, if that's going to happen, this will take place. And where's your next level for superior support? Right back here at 74.6. And after that, it's right back here again at 61.8. So if you were short here, if the indicators were lined up at this level, and if you were going to be short, a very close stop right above here, a point and a quarter, price profit target is all the way back down here. What's the difference between it? 1376 and a quarter from 1387.50. I can guarantee you it's greater than a 5-point move, isn't it? You bet it is. It's more in a 7-point category, isn't it? Yes, it is. You bet it is. So, knowing that, here's your 1 point, 1 1/4 point stop divided by the move. Your risk to reward ratio is now instantly much greater than 3 to 1. We teach all of this as well. This is everything, a big part of what we teach, the mechanics of being precise so that you limit your risk, because everybody knows that's been trading a long time. Listen, there's over 80 people in this room tonight, people, 80 people. And we've only been doing this for a year and a half, right? And I happen to know for a fact that we have some of the top technicians in the business here tonight. I can't mention who they are, but they're here. And they're looking at this for a reason, because it has direct application to profitable trading. And they're trying to learn something as well. Why not? The key to being a successful trader is being open-minded. Trading one of the true high probability trades. Waiting for the trade to come to you is your machete. And you cannot trade without it. Interesting. Holding at 100% right there. That's no coincidence, people. So, waiting for a longer term trend line to be violated, just like on the Dow before, right? Right extension. Here's your 100% retracement. Let's see if prices hit this level and hold it or trade right through it as a confirmation to be short, right, on the overnight session. Some of you trade the overnight session, some of you trade the open session. Either way. Money flow has surely come in on the 15-minute charts. But we need a short dump like this right here in order to consider going short. Here, the IMAs haven't crossed from above to below. Here, we have a different story on Chaikin because of the chart pattern. The Chaikin is a 21 period versus 14 period. A markedly different story. The money flow will have to have a substantial move to the downside for me to even think about going short. The MACD has crossed, is in setup 15-minute chart, because the 15-minute charts are the mother of all time frames, to be short, because the dominant trend is within the 15-minute charts as compared to the end of day. Stochastics would have to cross from above to below 80 here, and the signal line as well. 1 minute chart, at this point we are holding in a trading channel which has been most recently established by these data points right here. Here to here. We're looking for a lot of volume to come in right here. Something like this would be good. This may not happen for quite some time. These prices will probably trade in this channel, and if it's going to break to the downside, it's going to be a little later on. So that concludes the Fibonacci aspect, one more time, of the real-time demonstration and how this has direct application to trading on a professional level. Again, everything that we teach here. Now, remember, a trader will seek confirmations. A trader will seek confirmations by using Fibonacci retracement levels before any trade is ever taken. He or she should always use multiple time-proven indicators incorporating only objective analysis leading to actionable intelligence. because objective analysis is the preferred method to use to quantify a correct risk-to-reward ratio, like I showed you, before the trade is taken. All this before the trade is taken. Proper risk management is the key to longevity in trading the S&P E-mini futures market, and your key to a long-term trading career. Your self-created trading environment will help you eliminate negative influences and focus in on trading as a pro. And every day, we should apply ourselves an expectation of realizing our new trading career. So essentially what we have developed because of the new exclusive executive mentoring program is that I work together with you, you work together with me. This is, as it's known in the corporate world, a shared commitment. We're going through exactly this every day, a complete recorded session where the audio bridge is established just like this webinar. The screen share is established. You hear me, I hear you. It's only yours. After the session is completed, every session is 45 to 50 minutes. I make notes on your progress and what to do next. You get the session within hours because it's uploaded to my servers. You can see it on demand through a link that I provide in an email. And if that's not good enough, you can download it and keep it for life. Go portable. It's a WMV format file and see it on your phone, your iPad, whatever you like. You're completely portable without the internet. That's your choice. A new frontier in professional trader developmental education is what we have officially established. To trade the U.S. equities and the E-mini futures like a professional. And it's true that futures education, futures trading education has never been more important than right now. Employing the correct application of technical analysis can provide you with a decided advantage over the competition, a distinct advantage over the competition, to become a superior trader in the 3% category, where everybody wants to be, but almost nobody is. You follow a structured, learnable, and repeatable process to learn how to correctly identify, again, the true high probability trades, traders. You learn how to thoroughly calculate your risk-reward ratios before trading, enabling you to continue trading year after year as a professional does. So please write this number down. Everyone who's got a pen and have been taking notes to learn from this IMA webinar. The number is 718-395-9347. Again, 718-395-9347. We're talking about 10 to 20 days. Going from wherever you are, landing you at a professional trader level in a fraction of the time, at less than half of what anybody who's got any real name charges. I can guarantee you that. Why? Because this is about you. It's not about me. It's about getting you where you want to go. My money's made from trading. People who study here know that. If this is what you want, I mean if this is what you really want, you have come to the right place. And I will make sure that you get there. As far as you want to go, I'll take you there. You have my commitment. You have my word. So that concludes our presentation for tonight. And I want to thank all of you for being with me. This session has been recorded and it will be uploaded to YouTube within the next 24 hours. You will receive a link as a subscriber to be able to review this again on demand and as many times as you like. For those of you who are serious, have a serious interest, contact me. We'll set up some time. We'll talk in private. If it's a match, we can move forward with a serious agreement between us both. So once again, Jeff Kilian for the Inside Market Analysis. Thank you for joining us. We'll see you on the next IMA webinar in 2 weeks. All of you, have an excellent night. Good night.